Good afternoon, Madam Chair and members. Karen Lang on behalf of the California Association of County Treasurers and Tax Collectors. All 58 of them are concerned about disclosure. They support that part of the bill. If that was the only part of the bill, we would have been one of your biggest cheerleaders from the get-go. The lien was a big concern for us. We don't make money off of it. We just collect for the taxing entities, and so changes to that were incredibly problematic from the public administration of the tax bill. With the amendment, I'm hoping to come back the next time this bill is being heard, and strong support. So thank you to the author. Thank you to the chair.
Thank you very much. Next person speaking in kind of opposition.
Mike Lumiere, Senior Vice President of Y Green Energy Fund. Madam Chair, Vice Chair, and members of the committee, Y Green is a partner with Golden State Finance Authority and several other counties and jurisdictions across California. We were originally opposed to the bill as written, but now support with amendments, and thank the chair for all the work, the obvious work that he and his staff and the committee staff and Bank of Finance have done on this. We also support the amendments with strong disclosure language, and I would like to submit on record our regrets for the unfortunate circumstance that the Masons found themselves in. As soon as we were informed of the issue, we've suspended the contractor. They will undergo the normal process of review, investigation, retraining, and if they're allowed to re-enter the program, emphasis on if, and reach out to the Masons, and we'll work with them as we do with every property owner that does not have an entirely satisfactory experience with PACE. Again, we support the bill as proposed amendments with strong disclosure language, and thank you for your work today.
Thank you.
Good afternoon. Eddie Moreno on behalf of Sierra Club California. We also had an opposed unless amended position. We will review the amendments and get back to the author.
Thank you.
Madam Chair, members, Jolene Voris here on behalf of the urban counties of California. We also had an opposed position, but we're going to review the amendments, and we hope to be at least remove our opposition, if not in full support of the strong disclosures in the bill. Thank you.
Madam Chair and members of the committee, Joe Leviach with Renew Financial. Renew Financial is the program administrator for the California First program, representing over 350 local governments in California. We were opposed to the bill. We fully support a strong disclosure bill, and it should be noted that we are voluntarily doing this now, and anything that we can do to improve upon that, we fully support. Thank you.
Thank you.
Thank you, Madam Chair and members. Moira Top on behalf of the City of San Diego. We, too, had an opposed position. We very much appreciate the amendments taken today and the work by the author. We look forward to coming back with a changed position as well. Thank you.
Janine Windishausen, Placer County Treasurer, Tax Collector, and Administrator of the Empower Placer program. We'll be reviewing the bill and appreciate the amendments and are highly likely to support the bill. I want to also apologize to the gentleman who had any inconvenience with our program, and I look forward to following up with him. I believe we will have some solutions to assist him.
Thank you.
Madam Chair and members, Erin Niemela representing the Efficiency Council. We officially have an opposed position, but we really appreciate the progress and the amendments in the committee analysis, and we'll review that further. Thank you.
Thank you.
Madam Chair, Jane Elias with Sonoma County Energy Independence Program. We too oppose the bill, but with these amendments, we'll look at it and reconsider. Thank you.
Thank you very much. All right.
I move the bill as amended.
Okay. There's been a motion. I'll second that then. Okay. Ms. Whitten, you had a question?
Yes. Thank you very much. And it is the second time I've heard the bill. Heard it, had the privilege of hearing in banking, and at that time said, let's talk about the local government issues, and met with the county treasurers and talked with them. And that I really appreciate you taking the amendments and hearing that from the county's perspective that really shifts their ability to hopefully come in support of the bill. I think that was very important. I got good information from them. I think it's interesting here is that we're dealing with clearly some unscrupulous contractors who are taking advantage of consumers, and that is a very serious problem. I want to say my appreciation to companies that are addressing that issue and making it right. Our job is to prevent it from happening in the first place, and so I think that definitely the disclosure is important. We say the word regulation and people, break into a sweat, but that's probably also something that should be looked at. One thing that struck me was the idea of a prepayment penalty, and I know that it's prospective going forward, but I would love to see an amendment that wiped out prepayment penalties on all of these loans.
So would I.
So I would strongly support that. I think that's ridiculous. If someone can pay off that loan, they should be able to pay it off without any penalty at all. And I think that I appreciated the comments as the opposition, or removing their opposition, came forward. But I would say, to the constituents of yours who testified with their difficulty, and Y Green came to the microphone and pledged to work with them, that we have a lot of hearings ahead of us, and I would really appreciate feedback on the work that is done with that couple. When someone comes before us and says their retirement has been put at risk, I care about that a great deal, and we still have months to go in our process here in the state capitol to make sure that this really is a consumer protection work that we're committed to here. So thank you, and with that, I will be supporting the bill as it moves forward.
Thank you, Madam Chair. This is a serious issue, and I remember being on the City Council many years ago when PACE kind of made its debut, and I had concerns with it at the time, but it seemed like it had value, and it does have value. But the fact that it was a voluntary thing, made it worthwhile to keep it going along. And the issues have come forward, through the years. My concerns were always the fact that it was a lien, and I know for myself, if I went to purchase a house and it had this on it, maybe 10 years, so the technology's long gone, but you're still paying on it, that would make me shy away from purchasing the property. So, those things we'll all deal with at the hearing. But I just want to be sure at the hearing also we acknowledge that commercial properties are also part of this. And when we first heard it on the City Council, one of the reasons for PACE was to help business, because the amount of cost of doing energy upgrades for a commercial property were sky high, and it really benefited them to be able to do something like this. So I want to be sure that we can address that as well at the hearing. Thank you.
Thank you, Mr. Jones, and then Mr. Linder.
Thank you, Madam Chair, and Mr. DeBobnate. I'm just subbing in, and so I was introduced to this situation yesterday, and immediately piqued my interest as a local, city council member before I got here, and real estate licensee as well, and having some background in that. So I support the bill moving forward. I actually supported it before the amendments as well. I think for me, I'm not creating an opinion regarding the consumers or the contractors or the program itself. I think for me, the question I'm asking is this the proper role of county government to administer what I see a private transaction between a willing consumer and a willing seller? And I'm not convinced yet that is the proper role of county government or any local municipality to administer something like this. So I support it and look forward to seeing how this moves along in the process. Thank you.
Can I just address that? And this bill does not actually cover commercial property. Glad to have a discussion about that, but we do believe commercial property has a unique role separate of this, as a homeowner has less tools available than most commercial property owners in this regard. I would also echo some of your sentiments. It's hard sometimes for county governments to be able to regulate something that they're profiting off of.
Thank you, Mr. Linder.
Thank you. I want to start by saying that I'm a little bit disappointed that the super lien priority status was amended out of this. The reason why I believe that is because what FHFA did when they stated that there was a problem with these transactions was that they realized that then the traditional financing became significantly riskier. So what's been happening since is the local governments have appointed lenders an offer with significantly less risk than a traditional lender. But at the same time, it escalates the risk for anybody that decides to do any financing on these properties at any time in the future for traditional lenders. And a perfect argument is because I think that it's been said multiple times that yes, we by policy subordinate every one of these transactions if asked. I think it's contractual. They said that it happens every time. But there's no mandate to do so. So in the scenario where, say, for instance, somebody has a property and 80% of that property is encumbered by a loan, a deed of trust lien, and then they get one of these financing options, and it boosts that combined loan to value to, let's say, 90% at that time, or it could be less or whatever. But shortly thereafter, we run into a financial crisis, and homes lose their value by 30%. We don't have to look too far into the past to see something like this happen. This happened very, very recently. Now, all of a sudden, people are upside down. Now, is it going to be the fault of these loans and these assessments? Probably not. But I think what's going to happen is that these will be the focus of it. This will be what all the attention is going to lie on. And when all the focus is on these programs, this is going to be a little bit different than the focus when Wall Street melted down, or it's going to be a little bit different than we can't just blame bankers or people in these little that creating these creative financing type of scenarios. In this case, this was sanctioned by local government. So who's going to be in the hot seat when the chickens come home to roost? It's going to be the elected officials. So I wanted to point out what Placer County is doing, because I think that maybe this isn't the solution. There might be other solutions. Placer County offers or requires that if you're going to get one of these financing packages, that you get a seminar. The reason why I think that's good is because in my previous life, I was a title insurance guy, and I sat down in front of thousands of people that were buying properties, selling properties, and getting refinances, getting cash out, whatever. I sat for these signings a million times. A very, very handful of these times did it ever come up where somebody actually wanted to understand the details of every single provision in regulation in these documents. Most of the times, people think, oh, lawyers wrote this so they can cover their own. But they don't think of it as something that really mandates that they become informed. And maybe you have the right to make bad decisions or something. But I mean, these things are complex transactions. It's not a standard transaction. So with a county like Placer, taking the time to explain the super lien status and the super lien priority, I think that's a very, very good option. I think that I'd like to see something like that happen with these things in the future. But in regards to the subordination practice, I'm curious as to why, if this is the standard practice in these contracts, what's the difference if it becomes statute? And I'd appreciate it if somebody that was around could answer that. But I just see that this kind of creates winners and losers out of finance companies, and I think that it's a shame to kind of drop this mandatory subordination issue.
If I could, before I'll turn it over to let the industry respond, I will say I think it makes winners and losers out of consumers. Those that are lucky enough to be able to get a subordinate loan will have an easier time refinancing or selling their property. Those that don't, won't. In response to your other scenario that you eloquently portrayed for everyone, it is perfectly legal to take out 3 or more liens on one property. You could do one for a new waterless tank that makes your house more water efficient. You could do one for AstroTurf in the backyard. You could do one for solar panels. At the same time, you could have 3 or more liens on your property above the mortgage. And then when the next recession hits and the housing market collapses, unfortunately, we just saw this. We still have a fragile housing market just 5 or 6 years after the last recession. And people lose, in your case, you said 30% value, even 10 or 15% value. You could have a drastic and very real housing bubble created in this marketplace because people have lost that kind of value and now have all these liens and I've not heard a good explanation how that will be dealt with. So I appreciate your scenario that you portrayed, and I'd love to hear industry's thoughts on if they're already prescribing this as a solution and doing it willingly, where they've never turned down someone that's asked for a subordinated loan. We've heard 400. We've heard from another company 30%. What would be the damaging element to that if we made it into statute?
Sure, and I do have a follow-up question. I don't know if someone's prepared to answer that question, but now let's get back into that one scenario where we've had a financial crisis and someone's property is indeed underwater at this time. Well, when that happens, without some sort of requirement for subordination, there's absolutely zero incentive for any of these companies who, they were being out of good faith, they were subordinating these liens, but now their investors are losing money. The pressure's on. What's the incentive for them to say, we'll subordinate about some under a loan that actually was should have been junior to this particular transaction or financing. So in that scenario, you keep in mind you have maybe these investors that are putting pressure on the company to no longer subordinate. Well, these loans are going to be put in first position, and therefore the risk is going to be on these traditional lenders that have strict underwriting guideline, got the proper insurances from Freddie Mac or Fannie Mae, and went through the process. I mean, this is a very dangerous scenario, and I think that we can again only look to the past 10 years and saw what happened to say that this very well could happen again. And at that point, this is going to create a lot of problems for a lot of homeowners. Thank you.
And I thank you, Mr. Linder, because I think what you've done is, again, point out the complexities that we're trying to deal with. And I think to go back to subordinate, and I'd like Placer County also to come up, since they are a county who administers themselves and does not do the subcontracting on this issue. But to take one intervention that we don't really know is going to solve anything. We don't have enough information that it actually solves the issue and doesn't create a bunch of new ones. We have no indication from FHA, Freddie and Fannie, that
I have to counter that. FHA has made it very clear this is their remedy, and they do prescribe this, and it was provided to you.
FHF, right?
Yeah, so I have to counter that.
Okay,
respectfully.
But then, and we're glad to look at all that at the hearing. Do you want to respond?
Sure. I appreciate very much the comments, and I'm sorry for giving you my back. I would just make a couple of comments. The first is that I think the questions are well asked, and where we are today is you have what is effectively a new marketplace and a new product that's in the market, and we are learning as we go. That is why, frankly, the HERO program, Renovate America, led with putting contractual subordination in place in response to feedback that we were getting from the marketplace. And as we do that, we are doing this in a context of an overall marketplace. We've heard last August from the Federal Housing Administration that they were going to be putting forward guidance with respect to PACE. They have not yet done so. And so there is some clarity that is required at a federal level to understand what these products are going to look like and how they should be structured and regulated, which will enable us to then figure out how best to conform that asset in its fullest way. So we are, again, as I said at the beginning of my brief remarks, my brief testimony, we were opposed to the mechanics of AB 2693, but not the spirit. But we are taking steps in the appropriate way, and we believe that in that kind of measured way, we will come to the best public policy solution as well.
Thank you.
And in addition to echoing my peers' comments, I would like to offer a few data points. I think support our position at the current the program as it stands now, and strengthened by these amendments. Is safe, secure, and cost-effective for property owners. Y-Green and Golden State have completed over 14,000 projects, and 31% of which are in homes that have a GSE-backed mortgage. so 69% non-GSE. So implementing in statute what's already in policy of the subordination would have an impact on 2/3 or more than 2/3 of the market just in that one program, and it's the second largest, so obviously it's a broader impact throughout the state. It would result in restriction of capital, higher cost for that added uncertainty or diminishment of the security interest. So, as Ari said, in a new and emerging market and product, introducing some of those things in policy might be prudent, and has been. But in statute, I think the minimum would require more analysis and consideration.
Sure, and to kind of follow up with that, FHFA is a very conservative operation. I mean, they require very, very minimal requirements in order to insure it. So again, in order for them to have said that this is a big problem and puts their products at risk, and for them to say that they would deny underwriting on any of these financing, I think it says a lot. Now, I'm confident that they will come up with a very thoughtful solution to where because they understand their risk model better than anybody on this committee does. Mm-hmm. But to say that learning as we go is good enough, I have to disagree that I don't think that that's good enough, because sometimes when you learn as you go, bad things happen and you have to learn from those mistakes. I think that this is an opportunity to prevent mistakes from happening to people that are just trying to achieve the American dream. So with that, I'm still, like I said, I will support the bill. I think that there's a lot of solutions out there, and I think that this is like one part of maybe a larger solution. But I'd like to continue to be a part of it, and thank everybody for giving us the opportunity here. I will be supporting the bill, and thank you.
Okay, and I thank you and we had this document which announces the anticipated guidelines that they will be releasing. So the guidelines have not been released, but they have anticipated that they will release them. Next person from Placer.
Janine Winneshausen. I'm going to put on my tax collector's hat. First of all, there has been an assumption that local governments cannot do the contractual subordination, that we don't have the capacity. And the fact of the matter is that we do have the capacity. We've chosen not to do so. So I wanted to be very clear on that, first of all. I have reviewed the contractual subordination agreements from 2 programs. Mm-hmm. And what I see is forbearance of the right to foreclose on the part of the third-party provider and the pay. I'll just say the PACE provider. However, they do not release the rights under other revenue and taxation code. And so what that means is that while they won't take action in a foreclosure, separate and apart from that, under state statute, the county tax collector is required to sell that property at tax defaulted land sale for all of the taxes and all of the taxes that ride with it. And so there will be ultimate collection by the county tax collector. Mm-hmm. So I just want to clarify, it's in my opinion, it's a deferral of a foreclosure right.
Correct. That's how we understood it. Thank you. Mr. Cooley, you want to speak?
Thank you very much. I just want to say at the outset, I think the notion of a joint hearing is outstanding. I think this is a very important subject. I actually was supportive of the bill, and I more so want to speak to it on the basis of the ongoing conversation, which I know we will have. When you look at this bill is basically has 2 components. There is a disclosure piece, which everyone supports, to make sure individuals in these transactions are protected. But I actually think the more consequential piece, the most important piece for the legislature to weigh in on and give leadership to, is on the piece that addresses the dynamic of how the financial markets work. This is the large issue that California has a tremendous stake in. The nature of the secondary markets is we sell loans to the secondary market, so cash comes back into lending institutions in California and makes funds available to buy housing. So in an era when we are saying top priority is housing, anything that slows the cycle of dollars back through the secondary market is a matter of first importance to the state to understand and address. So I see that part of the bill, dealing with the subordination, as an effort for California to jump out in front of the federal government and drive this conversation about what would be feasible terms to do it. And I would say we're not breaking such new ground. Early in my law career, I was active in the early years of the Mello-Roos drafting the disclosure statutes. The Mello-Roos program is based upon a continuing lien, which gets recorded at a point in time and is effective over the course of that program. But at any given time, the only foreclosure can happen is on the most recent delinquent component, which is conceptually much like we're doing here. It's not identical, but it's sufficiently close to tell me that the secondary market long ago bought off on the idea that incremental delinquencies in a larger nut can work within the secondary market environment. So I think that's sort of where I would turn in response to Mr. Linder's question about how might this statutory thing. I actually think the pattern is there. This leads me then to think about, so how do you advocate with the feds? You advocate with the feds by developing your ideas to a coherent package and then advocating the heck out of it. There's actually something that was adopted in the 1980s, Reg CC, by the Federal Reserve Bank that I had a role in shaping by advocacy on behalf of a California-based client, just by thinking through the material details of a proposal and pushing it with the Federal Reserve. And I actually expressed to some of the proponents, I actually think it is a blunder to pull this portion out of the bill, because I think if we get to the point where we can work through the details of this lien in a pending bill, then all of the financial interest bankers, realtors, title companies, mortgage bankers will have something to start shopping in D.C. that's real and tangible and concrete and can kind of get people down off the ledge, stop hyperventilating. It's not going to tube the secondary market. They are under pressure after Dodd-Frank and the Basel Accords and all of the things that have come out of the recession dealing with financial security. And I think part of the reason for a statutory subordination is the issues of a contractual subordination, the reserve the state adopted just a year or so ago. These are credit enhancements, but they're not seen as sufficient credit enhancement to settle down the secondary market entities. So I think it is incumbent upon us to say, well, we tried that. Is there another way to settle them down? And I look at this bill as sort of based on the pattern of how Mello-Roos has operated, as offering a path for something that one bite at a time gives a delinquency right. I do know that the tax defaulting statute is a very complicated scheme, but I sort of think if we can figure out a workable mechanism, then the counties, the tax collectors, the title entities that administer these things can kind of work on the mechanics of how we might make it work. So I just want to express that I think that there's a lot to come in this conversation, and it's not beyond the pale to me that we might get to the fall and have something that we've kind of reached some closure on that we want to sell to the banking department and say California ought to be leading the way on this.